Hi everybody. So today we're doing the COMM 217 Fall 2014 final exam. Just Fall 14. Question 4. I read the question, and the story that came out of this question is that the company issued some bonds on October 1st, 2013, and then there's an intervening year end on December 31st where we have to record some interest expenses, but the first payment of interest is going to be on March 31st, 2014, and also we have a second payment of interest on September 30, 2014. So what you have to understand is that the company is issued some semi-annual bonds where they have to pay interest twice a year instead of once a year. So the date of issue is October 1st, 2013, and the bond are issued for 10 years. But as we read, it's a semi-annual bond, which means we're gonna have two payments date per year. In this case, our n is equals to the number of payments is 10 years multiplied by 2, because there are two payment of interest per year. Then the face value of the bond is 81 million. It's a huge amount. Okay. The coupon rate is 5%, but as we read, it's a semi-annual payment, so we have to divide it by 2, and this is going to give us 2.5% per 6 months. The coupon payment, which is the cash payment, is going to be the face value multiplied by the semi-annual rate. In this case, our coupon payment equals 81 million, which is our face value, multiplied by 2%, and this is going to be our cash payment every 6 months. So this is our cash payment every 6 months. The market rate is 4%, but again we have to divide it by 2 because it is semi-annual payment. Since the market rate is lower than the coupon rate, the bond is sold at premium. So just recall, every time that the market rate is lower than the coupon rate, it's going to be sold. The bond's going to be sold at premium. Vice versa. The year end is on December 31st. The thing I forgot to tell you about the story of this problem is that there is a redemption of bonds right after the first payment of interest. In this case, redemption of 70% of the bonds. And then they will normally continue for the other 30% of the bonds. So they're gonna pay interest on 30% of the bonds only. So let's start requirement 1. Let's read it. Let's start. We've been asked to calculate the cash proceeds received when the bonds are issued. The cash proceed is based on the cash on the present value of the principal to be received in 10 years for the investors, plus the present value of the annual interest rate of the interest payment that will be received in 20 payments. In this case, it's not annual, since we said it's semi-annual. And this is the amount of the cash payment that investors are going to receive each 6 months. The first step, when we want to calculate the present value of the principal, the first step is going to be to calculate the present value of the principal. In this case, it's the face value of the bond, multiplied by the PV factor. You're going to find the PV factor at the end. You're going to find the PV factor at the end of your exam. There are the tables there, and you're going to have two tables, one for the principal and one for the annuity. PV factor. Market rate of interest. So in this case, our face value is 81 million. Our PV factor is, by the way, this is N is 20, and our market rate of interest is 2%. Then make sure you have the market rate of interest instead of the coupon rate. This is a common mistake people make. Just make sure that you don't make this mistake. And don't forget to adjust it if it's a semi-annual payment or an annual payment. In this case, the factor is 0673, and this is going to give us 54,513,000. Second step is to calculate the PV annuity. This is the coupon payment. This is the cash payment that's going to be made over the in 20 payments over the 10 years. So our coupon payment multiplied by a PV annuity factor. Again, our N is 20 and our market rate of interest is 2%. Our coupon payment is 2,025,000. Our PV annuity factor is 16,514, and this gives us 33 million. So the addition of these two, it equals the cash proceed that the company is going to receive. It makes 87. It's 87,624,585. So this is the cash that the company received when they issued this 81 million bonds. As you can see, they received more cash than they issued. In this case, when we receive more cash, then when the cash proceed is higher than the bond issued, we know it's a premium because you received more cash than you issued. So our premium is equal to the cash proceed minus the face value. Of the bond. 7,624. The face value is 81 million. So we have a premium of 6,624,585. So now we have our cash proceed, we have our premium. We can record the transaction that on October 1st, 2013, which is the issuance of the bond. 3 accounts are going to be required. We received cash, so we have to debit cash. We have a premium to record, premium on bond, and we issued some bonds, so we're going to have a debt to record also. The cash received is 87,624,585. The premium on bond has to be recorded on credit. Just a way to see it, now it's going to do just record the debt, which is 81 million. So now you see that there's a difference between the two, and this difference is on the credit side, so you record the premium on bond on the credit side, which is 6,624,585. So we did the first requirement. We calculated the cash proceed, the premium, and then we recorded the issuance of the bonds. So the cash proceed, and then we have the premium on bond, and we have the bond payable. The next requirement asks us to prepare in good form a partial statement of financial position as at December 31st, 2013 for Doni Ltd. The way I like to do this kind of questions is because the requirement number 3 also asks us for the payment of interest in March 31st, 2014. The way I like to do it is to prepare an amortization table. When I do the amortization table, I'm going to have all the amount I need when comes the time to record the transactions, or to show the right numbers on financial statements. The first thing I'm going to do is to calculate the amount for the first payment of interest. The first payment of interest is on March 31st, 2014, which means 6 months after the issuance of the bonds. So this amount, this is the carrying amount beginning. This is what we had just on the issuance of the bonds. First, we're going to calculate the interest expenses. The interest expense, so this is number 1, is the carrying amount of the bond multiplied by the market rate of interest. In this case, the carrying amount is given, it's 87,624,585 multiplied by, don't forget, the semi-annual rate, guys, or girls. So this is the amount of interest expense for the first 6 months. Then we're going to calculate the cash payment of interest for the six first month. For the cash payment, it's the face value multiplied by the coupon rate. In our case, it's 81 million multiplied by by 2.5%, and this gives us 2,025,000. The third amount is the amortized discount. The amortized discount is equal to the interest expense minus the cash payment. In this case is 1,752,492 minus 2,025,000. This amount is 212,508. No, sorry. And then we have to calculate the unamortized part of the discount. The unamortized part of the discount is basically you take the unamortized part beginning, you add it to the amortized part, and this is gonna give you the new unamortized part of the discount. So unamortized premium. Sorry, I said discount premium. I mean unamortized premium beginning minus amortized premium. In this case, it's 6,624,585 minus 272,508, and that gives us 6,352,077. And our new carrying amount after the payment of interest is the carrying amount beginning minus the amortized premium. And in this case, it's 87,624,585 minus 272,508, and this is going to give us this amount. Okay. So now we have the amount. We have all the amounts we need for March 31st, 2014. But the question asks us to calculate to provide them with a partial statement of financial position on December 31st, 2013. In this case, if we go back to our story, we've been asked for this data. I know it's not required, but an easy way to do it is to write down the journal entries that you will have done on December 31st, 2013. This is going to help you to have an idea on which accounts are affected, so you can easily identify. So you can easily write down your balance sheet. So journal entry not required. So to do so, we need all the numbers for December 31st, 2013. What I'm going to do is I'm going to prorate these numbers. The number we had on March 31st, it's for 6 months. So if you go there, from the issuance of the bond to March 31st, this is 6 months. But from October 1st to December 31st, 2013, only 3 months of interest incurred. Even if we're not paying interest cash now, we have to record the interest expenses incurred for 3 months. So what we're going to do, we're going to prorate the numbers we have for 6 months to 3 months. In this case, we have some interest expenses for 6 months, so we're going to prorate this number for 3 months. So we're going to multiply all this. We're going to multiply the interest expenses. we're going to multiply the interest expenses for by 3/6, and this amount is 88,762,46. Then we need to prorate the cash payment for 3 months also. In this case, it's 1,012,500. And then same thing for the amortized premium. A bit confusing. So this is gonna be 136,254. For this amount, for the unamortized premium, I'm not gonna prorate it. So what I'm gonna do, I'm gonna do the same formula. The unamortized part of the premium, I'm gonna reduce from it the amortized part of the premium. In this case, it's gonna be it's gonna be this amount minus this amount, and it's gonna give us 6,006,000. It's going to be 488,033. And for the carrying amount on December 31st, again, I'm gonna take the carrying amount beginning, and I'm gonna add it. I'm gonna subtract from it the amortized premium for this for the 3 months. So the amount is going to be 87,488,33. So now we have all our numbers for December 31st, 2013. We can write down our journal entry. So as December 31st, 2013, we have an intervening year end. We have to record interest expenses that incurred for 2013, even though we're not they will be paid only on March 31st, 2014. So interest expenses, we're gonna have to amortize our premium. On bond. And then we're gonna have to record a liability of interest payables, since we're not gonna make any we're not gonna make any cash payment on December 31st. The cash payment is gonna be made on March 31st, 2014. So over here it's 876,246. By the way, all these amounts are on the amortization table. 136,254, and on these two amounts are on the debit side, and this amount is going to be on the credit side, since it's a liability we are recording. Okay, this amount is going to be paid. This amount is going to be paid in 3 months. The day in 3 months, on the payment date on March 31st, 2014. So now to do the partial statement of financial position, we know that we have interest payables. And we have interest payables. I'm just going to highlight it in yellow. This is an account that goes on the financial position, on the statement of financial position. This is an amount that goes there with the unamortized discount. So the first part, it's going to be non-current liabilities. So it's going to be the current liabilities. The reason I'm writing it down there is because I don't have enough space on this paper. So I have interest payables of 1,012,500. Also, I have non-current liabilities. These are long-term liabilities. This is the bond we have to record. So it had the bond. We have the we have the premium. And we have the carrying amount bond payable. The bond payable itself is the face value. In this case, it's 81 million. The premium on bond payable on December 31st is here. This is the amount of the premium, the unamortized premium on December 31st. So we have to take this number So our carrying amount on December 31st, 2013 is 87,488,331. So this is our carrying amount on bond payables on December 31st, 2013. So just make sure you have the good titles, you have the entities, you have the current liabilities, you have the non-current liabilities, because they asked you for to prepare it in a good form. So you have to make sure you have all the entities you need to. Then now we have to record the general entries for March 31st, 2014. In this case, it's the first payment of interest, cash. First time we're gonna have cash to pay. It's the only on March 31st and on March 31st and September 31st, these two these two dates are the only dates where cash is paid. So if you go back to our March 31st, 2014, we have to record again. We have to record for 3 months. We have to record for the other 3 months of interest. So 3 months of interest expenses that incurred from January 1st, 2014 to March 31st, 2014. We have to amortize the premium with that, and we have to make the payment of interest. So our account is going to be interest expense. We're going to have the premium to amortize. We're going to have the interest payables to pay. Don't forget, these are our current liabilities, and the payment is today. So we have to reduce our liabilities of interest payables, and we have to make the payment. So we have the cash payment. Yeah. We had calculated the numbers for 3 months, from October 1st to 2013 to December 31st, 2014. Now we have to take these numbers. So now we need to take these numbers and calculate them for 3 months, to prorate them for 3 months, from January 1st, 2014 to March 31st, 2014. As you know, it's the same mathematical operation, so we're going to have the same numbers. For the interest, we're going to have the same numbers for interest expenses, the same number, the same part of the bond that's going to be amortized, and maybe for the unamortized discount, it's going to be another amount because it has to be reduced by the same amount. In this case, our interest expenses for 3 months are 876,246. Our premium on bond payables is 136,254. Our interest payables is this amount. It's 1,012,500, and our cash payment is gonna be this cash payment. It's the first cash payment we made. So it's gonna be 2,025,000. Okay. So now we have the accounts, we have the amounts. So basically, just to recall what I did, is that I calculated the numbers for the amounts for March 31st, 2014, and then I prorated them to December 31st by multiplying by 3/6. 3/6 to find the amounts for so we can be able to record the transaction for December 31st, 2013. And then to calculate the numbers for March 31st, 2014, we had to record 3 months of interest expenses that incurred from January 1st, 2014 to March 31st, 2014, and then we also had to amortize the premium with that. Also, we had to pay to make the first cash payment. So this is the amount of the cash payment. Okay, so now we have to do requirement number 4. For this one, let's read it together so we make sure each part of it is clear. Assume that donor redeems 70% of the bonds for cash at 101 immediately after paying the interest on March 31st, 2014. Answer the following question based on this assumption. How much interest will be paid in total for the entire 10-year period of the bonds? And then they ask you for B, how much interest expense will be incurred in total for the entire 10 period. The difference between the two questions is this is the cash payment. So how much cash they're gonna pay over the 10 years after the redemptions. So you have to take into account the period before the redemption and the period after the redemption. And in this case, they ask you what are the interest expense, how much interest expense will be incurred in total. So this is not cash, this is only the interest expenses. To do this question, let's first do A, where they ask you how much cash you're gonna pay. You're gonna have to pay over 10 years. By the way, this is not a traditional redemption question. Usually they ask you to calculate the redemption proceed and then to record the transaction if there's a loss or gain, but in this case they don't ask you this, so don't bother yourself calculating the redemption proceed. They just give you this information, so maybe just to overload the question of information, so you get lost. So the first step I will do, I will calculate the first. Let's calculate the cash payment we made till now, as from October 1st, 2013 to March 31st, 2014. So this is one period, 1N. If you go back to our amortization table, we had our journal entry on March 31st, 2014. We made a cash payment of 2,025,000. So this is one cash payment. So for this period, we had paid 2,025,000 of interest payment. Now we need to calculate over the next 19th period. The reason why I recall we said it's a 10-year bond, but we have two payment per year, so we had to multiply it by 2, so we have 20 periods. We have 20 periods over the life of the bond. So now we have made we paid for 1 period, we have 19s left. From April 1st 2014 to September 30 2023, we have 19th periods. So first, I'm going to calculate the new face value of the bond after the redemption. So the face value is the first face value was 81 million. But as you said, they redeemed 70% of the bonds. When they say redeemed 70% of the bonds, it means 70% of the debt is gone. So we have only 30% left. So 1 minus 0.7 equal to 24,300,000. So this is our new face value. If 70% of the face value is gone, 70% of the premium is gone also. In this case, all we have to do is to go back to our amortization table. On March 31st, our unamortized premium is 6,352,077. So let's take this amount and take off from it 70%. And our premium is now 1,905,623. And you can assume that now we have a new carrying amount on bond payable. We have a new carrying amount, which is the result of these two, the addition of these two. Another way to find the carrying amount is just to calculate the old carrying amount by you add the carrying amount by, actually you take the carrying amount, you multiply it by 30%, and you're gonna come exactly to the same result. So this is our new carrying amount. The reason why I did this calculation is that it's going to help us to find the cash payment of interest. So the cash payment over the 19th period. So we're going to calculate the cash payment for 1 period. Is the face value multiplied by the coupon rate. In this case, it's 24,300,000 multiplied by 2.5%, and we have 607,500. So this is the cash payment for 1 period, for 6 months. But we have 19 period left. So let's take this number and multiply it by 19. So we have cash payment for 1 period by number of periods left. So 607,000 multiplied by 19, and this is going to give us 11,542,000. So this is for 19 period. But don't forget, from the beginning we said that we already paid 2 million of interest for the first period. We have 19 period, we have 20 periods. The first period of interest, as I said, first period. So the first period, this is the cash payment. So the total cash payment over 10 years, which represent 20 periods, equals 2,025,000 for the first period, plus 11,542,000 for the rest of the periods after the redemption, and this is going to give us a total of 13,567,000. Right. So just to make sure everyone understands, follows what we did, is that we had one we are as on March 31st, before the redemption, we paid 2,025,000 of interest. This is the cash payment we've made on March 31st, 2014. And then right after this payment, the company redeemed 70% of the bonds, which means we have only 30% of the bonds left. And we've been asked to calculate what's going to be the cash payment that the company is going to make over the 10 period life of the bond. We know that this 10 years has to be multiplied by 2 because there are 2 payments per year. So for a total of 20 periods, we made a payment for 1 period. We have a total of 20 periods, so we have 19 periods left. The cash payment for 19th period is this. The cash payment for the first period is this one. So all we did is we calculated the total cash payment over the 10 years, which means the 20 periods, by adding the first period of interest and then the rest 19th period, and we have this total. This is, don't forget guys, is the total cash paid. Alright guys, so for requirement B, we are asked to calculate the interest expenses over the 10 years. Recall from October and they ask us for October 1st to September 30, 2023. First thing, from October 1st, 2013 to March 31st, 2014, we already had incurred some interest expenses. If you go back to our amortization table, we can see over here that this is the interest expense incurred for 6 months, the first 6 months before the redemption. So this is our amount for the first 6 months. Just cut this. So 1,752,492. So this is interest expenses for interest expense for the first 6 months. And then now we have to calculate the interest expenses from April 2014 to September 30, 2023. The way we're gonna do it, we call this, guys, premium equals cash payment of interest minus interest expense. What we need, this is a total, okay? Total premium, total, and total interest expense. So now what we're going to do, we're going to play with this formula, and we're going to find that cash payment cash payment minus premium minus the premium equals the interest expense. So we have the total cash payment for 19th period. This is going to be this amount for 19th period, recall. So we have that, we have this 11,542,500. Our premium is over here, guys. This is our premium. After with the redemption, this is our premium. So let's put it down over here. 623. So these are going to be our interest expenses for the 19th period. The total is, if I'm not mistaken, is that 9,656,877. So these are the interest expenses. For the 19 periods after the redemption. After the redemption. So our total interest expense equals the first payment of interest, the first 6 months, which is in this case 1,752,492 plus the 19th the other 19th period, which is this amount. So now what we did, we took this amount and we add this amount, and then with that we're gonna have our total interest expenses for the 10 years of the life of this bond. And the total is 11,389,369. So this is our total interest expense. Just to make sure everyone understands what we did again, this is the amount of interest incurred for the first 6 months. This amount, we have it over here. We have it over here in our amortization table. And then we calculated the interest expenses for the 19th period after the redemption. This is what we did when we found this amount. And then to calculate the total interest expenses incurred for the 20 periods, or if you wish, over the 10 years life of the bond, we added these two. And this gave us 11,389,369. So this is the total amount of interest expense over the life of the bond. For requirement 5, the solution is pretty clear on this one, and we are running out of time. So I will just read the solution, and it has enough details. If you have any question about it, ask your teacher or your tutor. I'm pretty sure they're gonna answer you. Enjoy your exams, guys. Have fun and study well.